How to calculate futures hedging ratio. Imagine you're trying to protect your investment in a commodity like wheat or oil from sudden price drops. You want to know exactly how much of your position to hedge with futures contracts. That's where the futures hedging ratio comes into play. It's a simple idea but a powerful tool to manage risk effectively. The key to calculating this ratio is understanding how your spot price and futures price move together. The formula used is called the minimum variance hedge ratio, or MVHR for short. It helps you find the best proportion of your position to hedge so that your overall risk is minimized. To do this, you need 3 pieces of information. First, the correlation coefficient, which measures how closely the changes in the spot price and futures price are related. The closer this number is to 1, the better the hedge will work. Second, you need the standard deviation of the spot price changes, which tells you how much the spot price fluctuates over time. Third, the standard deviation of the futures price changes, which shows how volatile the futures contract is. The formula for the hedge ratio is the correlation coefficient multiplied by the ratio of the standard deviation of the spot price to the standard deviation of the futures price. So, it looks like this. The hedge ratio equals the correlation coefficient times the standard deviation of the spot price divided by the standard deviation of the futures price. If the hedge ratio is 1, that means you should hedge your entire position. If it's less than 1, you are hedging only part of your exposure. This often happens when the futures contract doesn't perfectly match the spot asset or when there's basis risk. For example, say you hold 100,000 units of wheat and your calculated hedge ratio is 0.8. You would then hedge 80,000 units by selling futures contracts. This way, you protect yourself from big price drops but still participate in some upside if prices rise. Remember, the hedge ratio isn't set in stone. It can change as market volatility and correlations shift. If the relationship between spot and futures prices weakens, you might need to adjust your hedge ratio. When the futures contract differs from the actual commodity, the hedge ratio becomes even more important. It helps you find the right balance to reduce risk without overhedging. To figure out how many futures contracts to buy or sell, multiply your hedge ratio by your total position size and then divide by the size of one futures contract. For example, if each futures contract covers 10,000 units and your hedge ratio indicates you need to hedge 80,000 units, you would buy or sell 8 futures contracts. In essence, calculating the futures hedging ratio is about understanding how your commodity's price moves in relation to futures prices. By doing this, you can decide the best amount to hedge, reducing your risk while still allowing some room for potential gains. It's a straightforward but essential step in managing commodity investments effectively.